Good evening, ladies and gentlemen. I would like to begin the evening by acknowledging the Wurundjeri people of the Kulin Nations, traditional owners of the land on which tonight's lecture takes place. We pay our respect to their elders, past, present, and emerging. Welcome to the 2019 David Finch Lecture at the University of Melbourne's Faculty of Business and Economics. As your host tonight, I would like to acknowledge my fellow Dean, Ian Harper, who is here tonight. I would like to especially welcome members of David Finch's family who are here with us this evening. Thank you for coming. It is fantastic to see so many of you here tonight for this lecture on global financial cycles. Maybe we all are a bit concerned. David Finch was an alumnus of this university. He graduated with joint honours degrees in commerce and arts in 1944. In 1948, he completed a PhD at the London School of Economics. After a short time at the University of Tasmania, David was appointed to the newly established International Monetary Fund, where he spent the rest of his working life. By the time he resigned in 1987, he was councillor and also director of the Exchange and Trade section of the IMF. In 1997, the faculty received a generous donation to endow a fund to honour Mr. David Finch by hosting a significant public lecture in his name. His achievements were recognised by the University of Melbourne in 2000, 2 years before his death, with the award of an Honorary Doctor of Commerce. The faculty is truly delighted to continue honouring David's achievements through this lecture series, and tonight marks the 23rd David Finch Lecture. We are very proud that over the years, the lecture has attracted world-leading economics and finance experts from academia, government, and international agencies. The lecture has been delivered by renowned international speakers, and tonight this tradition of excellence continues. Without further ado and stretching my voice, I would therefore like to invite my colleague, Professor Jeff Borland, to introduce our speaker for the 2019 David Finch Lecture.
So it's a real privilege for us to be able to welcome Helene Ray to University of Melbourne as the 2019 Finch Lecturer. Helene's the Lord Bargary Professor of Economics at London Business School, as well as being delighted to have Helene as the Finch Lecturer. We've been thrilled to have Helene as a visitor in the Economics Department for the last couple of days. I know the macro group have got a huge amount out of having Helene as a visitor, and she's been very generous with her time meeting with people and giving a seminar. Helene's known internationally for research on a variety of topics, determinants of and consequences of external trade and financial imbalances, theory and empirics of financial crises, and the organisation of international monetary systems. Because Helene's distinctive in having made major contributions to theory, to empirical research, and to applied policy research. There's lots of ways that I could convey to you her eminence, but I guess one of the ways to do that is the list of awards that she's won. Now, sometimes people say, well, if I read out all the awards, it'd take all night, and you think, oh, yeah. Well, actually, in this case, if you did read out all the awards, it would take all night. But just to give you a taste of a couple of the awards that Helene's received, she was the 2012 inaugural Birgit-Grodal, the inaugural winner of the Birgit-Grodal Award of the European Economic Association, honouring a European-based female economist who had made a significant contribution to the economics profession. In 2013, she received the Roe Johansson Award, shared jointly with Thomas Piketty, a biennial award to a European economist under 45 who's made a contribution in theory or applied economics that's significant in Europe. In 2014, she won the inaugural Carl Menger Prize an award given jointly by the German, Swiss and Austrian central banks for innovative international research in monetary macroeconomics and policy. And just so I can impress you with my French accent, 2015, the Prix Edouard Bonnefou, and in 2017, the Maurice Allais Prize. So, yeah, it's obvious that, that we have someone to give the 2019 lecture who's highly esteemed sort of within the international economics profession. Helene's also a member of the French Macroprudential Authority and the Bellagio Group of the International Economy. Tonight, she's going to talk about the work on global financial cycles, which she originated, and especially the role of monetary policy from the US Fed in creating those cycles. So please join me with welcoming Helene.
Thank you very much for this very generous introduction. So it's really a great honor to be here to give this David Finch lecture. So as it turns out, David Finch and we have some things in common. So as was mentioned, David Finch graduated from the London School of Economics in 1948. And it turns out I graduated from the London School of Economics exactly 50 years later, in 1998. But of course, he went on to have a very distinguished career at the IMF for 37 years. And there he tackled a lot of the very important international economic issues of the time. So including the famous UK mission of the IMF in 1976. But also, he thought about the reform of the international monetary system. And so tonight, I am not going to talk about the UK, but I am going to talk indeed about global financial cycles and the future of the international monetary system. So the menu of the lecture, which relies on a lot of joint research work with many fellows, researchers over the years, and which does not represent at all any views of the French Macroprudential Authority, is going to we are going to go through a number of I think, important issues related to the international monetary system. So first of all, I'm going to discuss the role of the dollar hegemony in the international monetary system. And then I will look at global financial cycles, show you some facts, and the role of the US Federal Reserve in all that, the interaction of the global financial cycles with various domestic financial systems. And looking into the future, I will point out that there is something like a new Triffin dilemma, which I will, of course, discuss, and see whether the current international monetary system is actually stable or not, and if not, what should we expect for the future of that system. So that's the menu for tonight, and let's see if we can discuss all these issues. So we are in a world of dollar hegemony. What does it mean? Well, that means that if we think about the way a lot of international transactions, both on the goods market, but also in the financial markets are conducted, they involve the dollar. If we think about global trade, there is a lot of global trade which is invoiced and settled in dollars. If we think about cross-border financial flows, there's a lot, again, of dollar there. In terms of bond issuance in particular. If we think about turnover in foreign exchange market, well, the dollar plays a very important role. If we think about monetary authorities, whether they fix their exchange rate towards countries or not, they tend to fix their exchange rate towards the dollar when they stabilize their exchange rate. And a lot of international reserves at central banks are in dollars. So there's a lot of dollar roles in the world economy in various capacities, both on the trade side, trading goods side, and also on the financial side. Now that's not necessarily at all a bad thing. That's actually a good thing according to the theory of hegemonic stability that was developed by Charlie Kindleberger, who was an economic historian at MIT, and who told us that for the world economy to be stable, it needs a stabilizer, some country that would undertake to provide a market for distressed goods, a steady, if not counter-cyclical flow of capital, and a rediscount mechanism for providing liquidity when the monetary system is frozen in panic. And this is not theory. I mean, if you think back in 2008 when we had the big Lehman Brothers shock, and actually there was a freeze in many interbank markets, and liquidity was missing, the Federal Reserve did provide dollar liquidity by gigantic swap lines to several central banks, and this did make a huge difference to the financial system, especially to European banks, by the way. So there is a benefit of having a hegemon to the system, at least according to this theory. But there's also, of course, there are also benefits for the issuer of a currency, for the hegemon to issue an international currency. So what are those benefits? Well, there's a number of them. One is the fact that if a lot of dollars are used, that provides international seigniorage to the US Federal Reserve, which is, it's some money coming. There's also the important issue of a stabilization of the terms of trade. If you issue dollar and you have all your transactions in dollar, well, it's good also for you if, for example, the oil markets and commodity markets are in dollars. That stabilizes your terms of trade vis-a-vis your key inputs in your economy. So that decreases the cost of transaction in the international economy for you if you invoice in dollar and everybody else uses dollar as well. As we also know, that confers some geopolitical power. If countries peg to your currency, if they use your currency in their international transaction, that means that your jurisdiction somehow extends to a bigger domain than simply within your border. And we have seen some examples of that lately with the example of, for example, the Iran sanctions. The sanctions against Iran of the United States, and the fact that the United States somehow could reach beyond its border because of the use of a dollar and punish people who are not respecting US foreign policy. So that's just an example of geopolitical power. There's also a very important issue, which is that if you are issuing the international currency, that means a lot of people actually are interested in holding your currency, in getting your US treasuries, US government bonds, in acquiring those assets. And therefore, if you need to borrow money and issue those US treasuries and government bonds, you will always find somebody who wants to buy them. So that relaxes your budget constraint. So this is what here I call a soft budget constraint. This is really a privilege of a hegemon to be able to do that with a lot of ease. And for some French, this is what has been called the exorbitant privilege exorbitant of the United States. Okay, and in particular, so this didn't go down very well in some quarters. So in particular in the French in the 1960s, this is General de Gaulle here on the dollar bill. And he expressed some frustrations many times. He said, this unilateral facility that the United States has implies that the dollar is not an impartial means of international exchange, since it is a means of issuing credit for one state, which is exactly what I said before. If everybody wants your paper, then you can go into debt and you don't have to worry about people taking it. So this is exactly what he was explaining in the 1960s. And of course, he did his best to end this hegemony and contributed to bring the Bretton Woods system down, which, not alone, but eventually Bretton Woods collapsed in 1971, 1973. However, despite his best effort, if we look today, many years after the collapse of Bretton Woods, and therefore after the collapse of a system in which the US was really at the center, because at the time of Bretton Woods, the dollar was convertible into gold, and everybody was pegging to the US dollar. Well, despite the collapse of that system and everybody going to a system of fiat currency not backed by gold anymore, and in theory with a lot more symmetry in the system, a system of flexible exchange rate. In fact, the role of the US dollar in the international monetary system has not gone down. It's pretty much either the same or possibly has increased in some dimension. So here I show you some data from the latest ECB report on international currencies. And you can see that the blue bars, which are the US dollar bars, are everywhere bigger than the other currencies. So you have the yellow is the euro, the red is the RMB, which is very, very small, and the green is the Japanese yen. So you see that if we look at international debt issuance, the dollar is far ahead. International loans, it's the same thing. Foreign exchange turnover, similar. The only maybe function in which we see that the euro is a close second is global payment currency. But if we look at the share of dollar in foreign exchange reserves compared to the other currency, it's very, very dominant. Okay, so you can see from these recent data that the importance of the dollar in the international monetary system has not gone down at all. If anything, it may have gone up. And another indicator of the importance of the dollar this time in international trade in goods is still the importance of the dollar in trade invoicing. So here what you have are the share of imports in blue and exports in red, which are invoiced in dollar. So if you had something that if you go to 2, that means that all your imports and all your exports are invoiced in dollar. You see, for example, a country like Colombia, which is the first one at the very beginning. I don't know if you can see from very far away, but that's Colombia. Close to all exports and imports of Colombia are in US dollars. Okay? And then as you go to the right, it's less true that the dollar is important. But we have Australia somewhere. So Australia is actually here. And you can see that for Australia, so the exports are very much in US dollar. The imports a little bit less, but it's still quite dollarized. Generally, if we think about the countries on the left, they tend to be Latin America and also Asia. And if we think at the countries which are more towards the right, so less dollarized, it's going to be more the European countries. Okay, so very important role of the US dollar still also in international trade. Now, is it a surprise that the dollar is so important in all these different dimensions? Not really, because the role, once you're important in one dimension, it's very likely that it's because you're also important in the other dimensions and vice versa. In other words, there is a complementarity across the different roles of an international currency in financial markets, in trade in goods market, in international reserves of central banks, etc. Why? Because think about it. When you use a currency, if you're going to use a lot of currencies in your international trade, a lot of dollar in your international trade, that means you want a lot of dollar liquidity. So you will want to park your liquidity in dollar assets, treasuries, short-term government bonds. But that also means that there's going to be a lot of dollar being traded in your foreign exchange market. So the markets for dollar is going to be very liquid. Okay, so everybody will want to use liquid markets. That's going to attract more business. That also means that your central bank, seeing that you are using a lot of dollar, will tend to want to intervene to stabilize possibly the dollar exchange rate. But if it does so, it will have to use reserves, or it's very likely to use reserve in US dollars. So it will have reserve in US dollar as well. So there are lots of complementarities across the different use of the currencies that make it very likely that if the dollar is used in one domain, it will very likely be used in other domains as well. That also means that it's very costly to deviate from such an equilibrium. If you choose not to transact in dollars, but everything in the economy uses dollar, you are going to pay a lot of transaction costs, and you're going to face a lot of exchange rate risk each time you do a transaction. So you will have an incentive not to deviate from the current equilibrium, and that makes that equilibrium quite stable. This is why it's difficult to displace an international currency by another international currency, because all of these complementarities, these network externalities, and these incentives not to deviate from the current equilibrium makes it very unlikely for an incumbent currency to kind of displace, for a new currency to displace the current international currency. We have seen it in history. We have seen it when sterling was displaced by the dollar. But as we all know, this took a very long time, and sterling was a very important currency even after the size, the economic size of the United Kingdom was relatively small compared to the size of the United States. Okay, so because of this complementarity, sterling really stayed an international currency for longer than we would have expected, and then finally got displaced. Started after the First World War, there was the interwar period with a little bit of chaos, and then the Second World War and Bretton Woods really that finished the job. But so it took a while. Now, this very important fact that De Gaulle was pointing out, the exorbitant privilege of the United States being able to issue these US treasuries and everyone wanting them, so the soft budget constraint, that translates into something quite interesting if we think of a country as having an external balance sheet, and this is what I'm going to show you now. So if we think of what the external balance sheet of the United States look like. So what do I mean by an external balance sheet? Well, so a country has assets, external assets, and external liabilities. What are the external assets of the United States? For example, if residents in the US buy Japanese equities, these are external assets of the United States. And conversely, if the People's Bank of China buy US treasuries, these are external liabilities of the United States. Okay, so this is what I mean by an external balance sheet. Now, if we think of the external balance sheet of the US, it looks like the balance sheet of a banker. This is why I call it the US as a world banker. So why is that? Because on the asset side, so that's going to be the positive side of the balance sheet, that's here the red line, what we see for the United States is that the US has equity and FDI, foreign direct investment. So it has risky assets on the asset side of the balance sheet. That's the positive red line here. So it invests abroad in net, it invests in equity and in foreign direct investment. But on the liability side, so this is what the investors buy from the US. What do they buy? Well, they mostly buy safe, liquid assets like US treasuries. Okay, so like a banker, the US is long, risky, and it's short, safe, just like a bank balance sheet. Okay, this is why the US is the world banker. And you can see that the short, safe is pretty impressive. You see the blue line, it's kind of getting down. It's towards the minus 50% in terms of US GDP. So these are big, big, big numbers of US short or safe liabilities that are being absorbed by the rest of the world. Now, what does that mean? That means that just like a banker, so the US will get an intermediation margin because it has risky assets and it's short safe, then it's going to earn an excess return on its external balance sheet. And we could estimate, with Pierre-Olivier Gourachas, we could estimate how much this excess return was, and it's about 2% in real terms per year since the 1950s. So it's not a negligible amount. Okay, so that's the intermediation margin that the US can have. However, so you can see that the structure of this balance sheet also has some very important implication in times of crisis, in global crisis times. So what happens if you have risky assets and if you issue safe liabilities? Well, in global crisis time, the value of your risky assets goes down massively, because any risky assets goes down massively in global crisis time. That's what we saw in 2008, 2009. And the value of a safe liability doesn't go down. By definition, it's a safe liability. It's the reserve currency. So in global crisis time, you have the assets going down massively, and the liabilities not going down, possibly even going up, because there's a safe haven property of the dollar, people go into the dollar. So that means you have a negative wealth transfer from the US to the rest of the world in crisis time, because value of asset goes down, value of liability goes up. So what is it? That's a negative wealth transfer from the US So that's a wealth transfer from the US to the rest of the world. So in that sense, during global crisis, the hegemon, the issuer of a reserve currency, is providing insurance to the rest of the world. So the US is not only a world banker, by the structure of its balance sheet, it's also a world insurer, okay, because of these transfers that happens in crisis time. And so in some paper, we interpret this 2% exorbitant privilege, this 2% excess return on the external balance sheet as a kind of insurance premium, an insurance fee that the rest of the world is willing to pay the US in exchange for insurance, these transfers during crisis time. Okay, so that's literally like an insurer would do. You pay a fee in normal times in order to get some insurance in bad times. So that's why, in that respect, the US is a world banker and a world insurer. And another way to see that is that if we look, it's not only in 2008, so it's not only during Lehman Brothers that we see these transfers from the US to the rest of the world. If we track times of turmoil as measured by the VIX, which is this blue line, so the VIX is a kind of, it's a financial market instrument that is reflecting fear in the market. It's usually regarded as a proxy for fear in the market. It's reflecting expected volatility and also the risk aversion of the markets. And each time the VIX spikes, it means it's a crisis time. And you see that each time the blue line spikes, we see that the red line, which is the net foreign asset position of the US divided by GDP, tends to go down. So when you have the big spike, the big last spike that you see here, this is Lehman Brothers, and you see the negative spike in the US net foreign asset position, that's the transfer from the US to the rest of the world. That's the insurance transfer. But you see that the negative correlation is more general than only for the Lehman shock. Now, so I'm hoping I've convinced you that the US has really a central role in the international monetary system. And it's very important to understand, therefore, also the fluctuations in the value of the US dollar for a number of reasons. So I'm just going to dive a little bit into that and to try to see what are, therefore, the implications of both the balance sheet of the US and what are the implications of a balance sheet of the US for the value of the future value of the US dollar. So this is what I'm going to discuss now. When we think about a country, and here I'm going to apply that to the United States, but in general, when we think about a country that is running a lot of external deficits, okay, so each country faces an intertemporal budget constraint. So if I have a lot of deficits now, it will mean that at some point I will have to repay my debt. Because if I have a lot of deficit, that means I borrow a lot from the rest of the world, and at some point, I will have to repay. So usually, how do we think about this I will have to repay bit? Well, for a country, having to repay to the rest of the world, that means I will have to go from deficit to surplus on my current account. That's one possibility. So in order to do that, I will have to export a lot in the future. And if I need to export in the future, usually that means that in the future, my exchange rate will have to depreciate. So that has some implication for the future of the currency. But there's another possibility. If I borrow a lot and I have a lot of deficit now, there's another possibility for me to repay my debt. And this is by having positive gains on my external asset positions. I have external assets. And in order to repay the rest of the world, what I can also do is make capital gains on my external asset position. That would be the valuation adjustment channel, as opposed to the trade channel, which is about having future net export growth. So both channels, in the case of the US, involve movements in the dollar in the same direction. Why? So net exports probably will require depreciation of the dollar in the future. But also the valuation adjustment channel require a depreciation of the dollar. Why? Well, again, let's think about this balance sheet structure of the US. On the asset side, let's say it has equities denominated in yen. On the liability side, it has US treasuries. So the liability side is in dollar, but the asset side is in foreign currency mostly. In that situation, if you have a dollar depreciation, the liability doesn't move because it's in dollar. However, the value of your assets, if it's in yen, it will go up in dollar terms if the dollar depreciates. So for the US, having a dollar depreciation helps both on the trade in goods side and also on the financial asset side. This is quite an interesting property of the US balance sheet. If you had an emerging market, it would not work that way, because usually when there's a depreciation of your currency, it doesn't help your balance sheet. But for the US, it does. Okay? So both channels of adjustment points towards the importance of the dollar and the dollar depreciation in order to enable the international adjustment of the US. So it turns out that if you look at this in the data, which is something that we had done in a JPE paper back in 2007 with Pierre-Olivier, and we recently updated the data. It turns out that if you measure properly these external deficits of the United States, and you look at the predictive power of this current external deficit on the future value of a dollar, which is what we have done here, well, it's a pretty good future predictor of the value of a dollar. Not at high frequency, so let me explain to you what these things are. So here, the blue lines are always the US dollar. But here, this is 1 quarter ahead. Here, this is 4 quarter horizons for the US dollar. Here, this is 8 quarter ahead and 12 quarters ahead. Okay, so it's high frequency dollar movements and low frequency dollar movements. And the red and the green line are simply what you get by using this idea that I just told you, which is that if you measure the current deficits of the US now, that should help you predict future adjustment, and in particular, future adjustment via depreciation of the dollar. So if you use this simple idea, you can see that actually it works pretty well in the sense that this red line and this green line predict the movements in the US dollar, both in sample and out of sample, pretty well, especially at low frequency. At high frequency, you see there's a lot of noise and you don't get much. You get roughly the turning points, but you don't get a lot of the movements. But at the low frequency end, you see that we are doing pretty well in predicting the dollar. So it means these valuation channels of adjustment and these trade channel of adjustment are important, and they help you to think through the future value of the US dollar. So now when we look at the data and we compare, what happens in terms of international trade adjustment versus financial adjustments, valuation adjustment channel between the beginning of a sample and the more recent period, what we find is actually the predictability of external returns, even after the 2008 crisis, is quite important. And using the measures of US external imbalances. And so what that means is that it looks like there's an increasingly large share of the US adjustment that occurs through essentially the return on liabilities on the US side of the balance sheet. So that really means that the US occupies a central place in the international financial system, and this is despite the decline of the share of the US economy in the world economy. And I will come back to that towards the end. So that's what we can say about the implication of the US external balance sheet in terms of what it means for the dollar. So now we've seen the hegemony of the dollar, various measures of it. We've seen what it means for the structure of the external balance sheet of the United States, what it means for the process of external adjustment and how it goes through the dollar. Now, what I would like to turn to the effect of US monetary policy on global financial cycles. So what are global financial cycles? So this is the co-movements of gross capital flows, credit growth, leverage, risky asset prices around the world. Okay, so this is really a concept which has to do with the world economy and not a national economy. And as I will show you, there are also very there are lots of co-movements across these various variables, and there's also interesting correlation, again, with the VIX, this variable of fear in international markets that I have shown you before. So just a very simple view on this idea of global financial cycle. Here, this is just the correlation across capital inflows between 1990 and 2018. And this is, each cell is just a correlation number of a class of financial assets, let's say portfolio flows, or foreign direct investment, or credit. And this is between different regions of the world. So you have portfolio, say North America, portfolio flows into Asia, portfolio flows into European Union, portfolio flows into Africa, into Latin America, emerging Asia. Okay, these are the geographical coverage. And then you see that each of the correlation of these portfolio flows into North America with, for example, foreign direct investment into Asia, etc., all of these correlations are green on this chart, which means they are positive. There's very few correlations which are red, which would mean they are negative or they are negative. So almost everybody is positively correlated. So that means all the inflows in any asset class to any region, essentially, are positively correlated with one another. So that's for inflows. So it's a very simple, graphic view of co-movement. And this is correlation across capital outflows. And you see pretty much the same thing holds because it's all green. That means it's all positive again. Okay? With very little red here. Now, if one pushes that a little bit more on the econometric side, one can look at some characterization of the global financial cycles which are a little bit more, let's say, sophisticated. So if I take all these capital flows that I've shown you, and I try to estimate one global factor which is common to all these capital flows. So I can do that with a dynamic factor model. And it will turn out that there's one global factor which explains about 20 to 25% of a fluctuation in gross capital flows. Okay, so that's a large share. For a very big panel, that's a large share. I can do the same type of exercise for risky asset prices around the world. So lots of stock prices and corporate bond indices for many countries and different continents, and I can estimate a global factor. And what I can find is that there's one global factor that explains 25 to 30% of the fluctuations in risky asset prices. So in both cases, it's a non-negligible amount. And furthermore, what I will show you later is that US monetary policy is going to be an important driver of this global financial cycle. But let's take a look at this one global factor, both for asset price and for capital flows. What do they look like? So here is what the global factor in asset price in blue and this one global factor in capital flows in red look like. You see that what is quite striking is that both of them explain about a quarter of the variance of these big panels in both cases, but also what is very striking is that they are very highly correlated with one another. So that's a global financial cycle. That's this kind of global co-movement in flows and in asset prices. And what is also quite interesting is that if you plot on the same graph the VIX, which is, again, this index of market fear, you see that, again, this negative correlation is very much there. Each time the VIX spikes, which is a global turmoil time, you see the big spike in 2008, then there is a collapse, both in the global factor in risky asset price and also the global factor in capital flows. Okay? So this is quite a striking co-movement with a negative co-movement of the VIX and the global financial cycle. So what kind of explanation can we have for such a, kind of striking co-movements? Well, I think here I'm going to quote another David Finch lecturer, who gave a David Finch lecture in 1999. That's Andrew Crockett. Was, I think, the right explanation for this co-movement of quantities and price in the financial markets. And he said in the financial sector, the price that falls when the supply of credit increases is the interest rate. This has the effect of pushing up asset values and appearing to strengthen the balance sheets of borrowers and intermediaries alike. Rising asset values encourage leverage and credit expansion, contributing to further increases in credit growth. So in other words, you have this kind of feedback effect, which makes everybody looks good. Asset valuations go up, there's more credit creation, valuations look even better, and there's more transactions, and you see it in quantities as well as in prices. Okay, so I think that's a very important mechanism at the heart of financial transmission. Now, so that's what the global financial cycle looks like, this co-movement of price and quantities, but what drives it? And I'm sure there are different things that drives it, but I have identified one. And the one I've been working on is the effect of US monetary policy on the global financial cycle. So on that, done some work with Silvia Miranda-Agripino, and we have identified monetary policy shocks from the US Federal Reserve and look at the effect of, let's say, 100 basis point tightening of the US Federal Reserve on the global financial cycle. And so here I'm showing you these three panels. So it's a tightening of 100 basis points. The first one is simply as an illustration, the effect on the dollar. And this is a real effective exchange rate of the dollar. So when the Fed tightens, the dollar appreciates. That's an appreciation of the dollar. The second one is the effect of a tightening on the global factor in risky asset prices. And you see that when the Fed tightens, the global factor in risky asset prices goes down. Okay? And here it goes down, it translates into a roughly 10% decrease in a broad stock market index. So that's a sizable effect on the global factor in risky asset prices. And the third one is a measure of global risk aversion. So when the Fed tightens, this is a risk-off period. Global risk aversion goes up. Or you could see it if you put the VIX would go up as well. So the way I understand global risk aversion here, it's the fact that the Fed has an effect on this risk-on, risk-off period in financial markets. It's not that there is a change in the risk aversion of specific people who suddenly become necessarily more risk averse, but the way I see it is more in the context of asset pricing done by different financial intermediaries. There are some times where some type of financial intermediaries expand more than others, so in some times where they are more important in markets than others. And if these are the more risk-taking intermediaries we expand more, then we are going to see it in asset pricing. Valuations will go up. But in times of the more risk-taking intermediaries will retrench, then asset prices will go down. So this is about the mix on the importance of relative financial intermediaries in financial markets who are going to drive these fluctuations in global risk aversion. As an illustration, I'm showing you on this graph international capital flows between the 1990s and a recent period. And you can see that during the period 2003 up to the financial crisis, 2007, there is a large increase in this blue part here. So it's been a massive expansion of flows by a certain type of intermediaries, which were the global banks. And so the global banks, because they were relatively lightly regulated, took a lot of risk. So in that part, you could see the global risk aversion going down, I think largely because these lightly regulated intermediaries, very risk-taking, were very important in international transactions. But that's an interpretation of the data. Now, when we look specifically of the effect of US monetary policy. So again, same tightening of the Fed on the leverage of these global banks. We see indeed that if we look at the leverage of US broker-dealers on the left panel, or the leverage of EU global banks on the right panel, in both cases, when the Fed tightens, the leverage of the US broker-dealers or the leverage of EU global banks goes down. Okay, so both react to a tightening of the Fed. That means the Fed monetary policy doesn't stop at the border. It affects very much financial intermediaries from global intermediaries from Europe and elsewhere, which is consistent with the whole story I've been telling before. Okay, so that's the global financial cycle. So should we do anything about it? Should we worry about it? Does it interact with domestic financial system? I guess is the next question. And there, so this is where we go to the idea of dilemma versus trilemma in international economics. So what is that? Well, in international economics, there's this well-established idea that we have a trilemma, which means that you cannot have at the same time an independent monetary policy, also a fixed exchange rate, and free capital mobility. Okay, these three things are incompatible with one another. And we can all see that if we have free capital mobility and if we fix our exchange rate, then essentially we cannot have an independent monetary policy. If you fix your exchange rate vis-à-vis the dollar and you have free capital mobility, if you try to deviate from the monetary policy of the Fed, it's not going to work. So in other words, a country like Hong Kong or a place like Hong Kong pegging to the dollar is not able to have an independent monetary policy because it has free capital mobility. However, what the trilemma also implies is that if you have a floating exchange rate, like Australia, then even with free capital mobility, you can have an independent monetary policy. So in other words, a floating exchange rate is insulating your economy from foreign influences. So that's an implication of the trilemma, as is commonly understood and applied at the IMF and in other places. Now, I think what the global financial cycle evidence shows is that that's not quite the way the world works, because when we are in a world with a lot of capital inflows, well, the global financial cycle is there, regardless of your floating exchange rate regime or fixed exchange rate regime. And it's actually, the global financial cycle is actually relaxing or tightening your financing condition in your domestic economy via these effects on the global banks or whatever, or the multiple role of the dollar. And this is irrespective of your domestic financial conditions. So the global financial cycle has an effect on your financing condition, even if you have a floating exchange rate. So that means that if you want to control for this effect on your financial conditions, you cannot do it only by having your exchange rate floating and then just doing your monetary policy business as usual. You'll have to tackle this effect of a global financial cycle on what is happening on your domestic financial markets. And this is the role, I think, of macroprudential policies. What we see, I think, very much in the data on banks, and I actually have given a seminar on that in the department yesterday, is that the global financial cycle, by affecting the tightness of the value at risk constraints that are used by banks and other intermediaries, has an effect on how expansionary some financial intermediaries are, how much credit growth is being created, and in some cases that may lead to too much expansion of some financial intermediaries, too much credit being created, and concentration of risk on some balance sheet of large international banks. So let me show you again for the same period what happens to the leverage of some banks between the 1993 and the year 2015. And I just want to show you that during the period where we've seen all this big impact of global banks in international financial markets, where we have seen global risk aversion so going down, and a lot of high valuation in asset markets, if we look at the most leveraged banks, this is the top 1% in terms of quantiles of banks. So the most leveraged banks, the biggest bank, you see that they have leveraged up a lot up to the crisis. Okay? And this is a very particular behavior. If we look at the banks which are less leveraged, the median here of the distribution of the bottom, you see that the time series look very different. So what that means is that during that period that we have been looking at between the 2003 to 2007 period, there was a lot of leverage in the big financial intermediaries. That is to say, there was a very positively skewed leverage distribution and hence a lot of concentration of risk in the large balance sheet of banks, which is obviously very dangerous for financial stability, as we have unfortunately experienced. So this is this type of thing that I think macroprudential policy should be careful about and do something about. So if we believe in these global financial cycles and this concentration of risk on the balance sheet of some financial intermediaries, so what can we do? What are the policy options? So one can think of acting at the source of the global financial cycle, and that would mean for the large currency areas, so of course, first of all, the United States, but other central banks here in large currency areas are also important. That would mean they should internalize better the effect they have on the joint provision of liquidity to the international monetary system. And also they should internalize better when they changes the regulation of a financial system, the effect this has on the joint cost of funds for financial intermediaries, on the joint liquidity in the world economy. Okay, so that will require some internalization, so some coordination, which is very hard to get. But at least some awareness of this would be important. Another thing that one can do to decrease this excess credit growth in some cases is to be very careful about the fiscal incentives that are given to debt and any fiscal incentives that encourage leverage in financial system. So in particular, in some countries, there's a lot of fiscal incentive used in real estate markets that drive up housing prices, and then this has an effect through the financial system, the same type that Andrew Crockett was describing. So this is for the source, but one can also think about acting directly on the financial intermediaries which are really initiating the cycle. So this would have been global banks during the 2003 to the 2007 period in particular. And that's the role of macroprudential policy, to limit credit growth, leverage, and to be very careful about the level of risk-taking. So there are various macroprudential tools that one can use. But also mean that this mechanism of positive feedback loop, they can work on the upside of a credit boom. They can also work on the downside. So one can also use macroprudential tools to avoid credit crunches and retrenchment when there is a downturn. And also, one can act on the transmission channel by imposing the same type of macroprudential policies, not only on the initiators, so possibly the global banks of the big currency areas, but also when we think about emerging markets, where on the receiving side of these capital flows, one has to think also about macroprudential measures for the financial system on the receiving side. And one can there think either about macroprudential tools or possibly some capital flow management tools. Now, I think this all points towards a very important issue with currently the policy tools that we have. We have developed over many years frameworks for monetary policy, inflation targeting, etc. But we don't have the same level of sophistication to think about macroprudential policies. We are nowhere near. And I think that's really something that we have to to develop in many different dimensions. So here I've given a few ideas, but I think there's really a lot of work to be done in terms of macroprudential policy. Okay, so now that we have, I hope, gone from the dollar hegemony to the global financial cycles and the consequences, this is the way the current system, I think, works. But the big question is it stable, this system? Is it going to change or not? And this is now the question I want to turn to, is should we expect, just like we went from sterling to the dollar at some point, are we going to see a big change in the international monetary system? And in order to think about that, I think we have to start from the very simple view of the world economy here, which is just the size of the respective countries in world GDP. So as you can see, the United States is the red line, and the relative size of the US in the world economy is going down. The projections here are until 2025. And you see that the blue line, which is China, is becoming bigger than the US. The European countries are shrinking as well. India is growing, as you would expect, and emerging Asia as well. Japan is going down. So you see that there is essentially a shrinking hegemon problem. The size of the US in the world economy is going down. And I just remind you that the size of the United Kingdom in the world economy went down, and with a lag, we went from sterling to dollar. Right? So we have a similar kind of historical pattern here with the size of the US going down. Now I think the immediate implication is that since the US is providing the safe asset in the world economy, then the size of the US going down and the rest of the world going up and demanding a lot of safe asset, this creates a lot of or some excess demand for safe asset, and that could be one of the factors pushing down global real rate. Okay, so this is something that Pierre-Olivier Gouenchas discussed when he gave the David Finch lecture, actually, 2 years ago, and I think that's one of the factors behind the decline in real rates. There's also a cyclical deleveraging effect, which in my view is also pushing down real rates. But this is something that we're seeing now. But there's another maybe more fundamental implication of this shrinking hegemon issue. And this is what I will call the new Triffin dilemma here. So what was the old Triffin dilemma? We go back to the 1960s, and we are in Bretton Woods. And at that point, so the dollar is backed by gold as a fixed parity. Okay, so if you have dollar, you can get gold in an amount which is fixed. Now imagine the 1960s, the dollar is used internationally a lot, the world economy is growing, so there's a huge demand for dollars in the rest of the world. The stock of gold in the US, the reserve of gold, is pretty much fixed. So you have a lot of people having dollar, and it is backed by a fixed stock of gold. At some point, people having dollar wonder whether the dollar they have will be able to be changed into gold. There won't be enough gold for everyone at a fixed price. So at that point, when people start to doubt that the parity of the gold with the dollar can be maintained, there is a confidence crisis, and this is a run out of the dollar at that point into Deutschmark. Okay? And this starts to be the collapse of the Bretton Woods system. And Triffin, who was professor in Yale, kind of discussed this dilemma before essentially the collapse happened. So the dilemma was, many people, if the dollar is successful, many people want to use the dollar, but if many people want to use the dollar, there's going to be a confidence crisis. That was the Triffin dilemma. So now, we're in a similar situation. Of course, the dollar is not backed by gold anymore, But what is backing the value of the dollar as an international currency is the fiscal capacity of the United States, is the fiscal backing of the US. And we're in a similar situation in the sense that the dollar is very much used internationally, but the size of the US dollar, of the US economy, is shrinking in the world economy. So the fiscal backing of the dollar is shrinking. And yet we have a growing demand for US dollar. So at some point, there is a genuine question regarding whether people will trust the dollar. And this is the new Triffin dilemma. Right. So that means that in my view, the current system, again, for the same reason that Triffin pointed out in the 1960s, the current system may not be stable. And therefore, at some point, we will have to switch out of a dollar-dominated system to either a new currency-dominated system or a multipolar system, a system with more than one international currency. And the big question that one can try to think about is what would be the challenger currencies if that were to happen? And I will finish with this. So in 1960s, the system switched out of the dollar into the Deutschmark. Okay, and then there was a collapse, and we went out of the Bretton Woods system and into the flexible exchange rate system that we have been discussing. Now, in this time around, so what are the possible competitors to the dollar? So the second main international currency is the euro, as we have seen. But of course, given the size of China, the RMB has to be one potential currency. We have seen the emergence of cryptocurrencies, and we are discussing a lot these days digital currencies. So does it matter? So if we think about the euro, it is the second main international currency. However, why isn't it becoming more important in the international financial markets? I think a big reason why the euro is not becoming more important is that there is no true safe assets denominated in euro. As you know, the euro area is a weird construct for the moment. It has one central bank, but it has 19 different treasuries backing the currency. It doesn't have one fiscal capacity backing that currency. It has all these different countries, and this is causing a lot of issues, a lot of problems. Okay, so there is a problem with the financial architecture of the euro, which I think is preventing the international role of the euro to essentially take off. The RMB, so the RMB so far, I mean, as we have seen, there is a lot of potential in the long run, but financially very underdeveloped, convertibility issues. We do see a clear push from the Chinese authorities to favor the internationalization of the RMB, offshore RMB bonds, petro-yuan contracts, entry into the SDR and the IMF, but we are far from having a viable international currency, I think. Then, of course, a very hyped couple of years ago, there was things like bitcoins, cryptocurrencies. But cryptocurrencies, in my view, so first of all, the blockchain type of technology, the decentralized one like bitcoins, which involve proof of works, it's really completely unclear which problems they were supposed to solve, but they clearly create a lot of problems. Huge environmental costs of these things, and as we have also seen, there's a lot of fraud which is associated with bitcoins and cryptocurrencies in general. So it has been used for the dark web, etc. It has no fundamental value, essentially. And as a result, because it has been very, very volatile in terms of valuation, it's a bad medium of exchange, store of value, and unit of account. So I would totally discount these objects, like Bitcoin, to play any important role in the international monetary system. What is much more interesting, maybe, are the digital currencies, which can be issued either by central banks or by big companies. And here the most recent proposal that we had was Libra, which is a stable coin that has been proposed by Facebook, using the Facebook network users and backing Libra by assets in existing currencies. So there, I would say, first of all, what is interesting here might be the transaction technology, but there is absolutely no reason why using better transaction technologies, which arguably you could say cross-border Facebook has compared to the existing payments that we use cross-border, there's absolutely no reason why new transaction technology should be coupled with new currencies. And I would say that in the past, whenever we had private money versus public money, this is why we switched out of private monies, because they created, if you have private monies, we have experience of financial instabilities which were not very good, and therefore that's why in a way we created central banks to switch to public currency. So I would be extremely careful with privately issued currencies. But more deeply, I think if we think about the difference between a privately issued digital currency and a publicly issued currency, there's a very big difference. When governments issue currencies, and they are used because they are the legal tender, well, in exchange for having their currency used, the governments provide public goods. These are financial stability, macroeconomic stabilization, monetary policy, for example, and also they use seigniorage revenues to provide public goods. They do public expenditure on various items. So that's the counterpart of having their currency used as legal tender. If we think as a big firm, the motives for big firms issuing currency, such as Libra, again, if it ever comes to life, then yes, people could use it because the existing network is there, and the transaction technology might be very good within that network. So what it would provide to the public is potentially a better transaction technology, especially cross-border, where our current technologies are not very good. But in exchange, what does the private company get? It gets profit and it gets data. Okay? And so it's a very, very different type of transactions for a private company to provide currency compared to a government-issued currency. So this is why I think the regulators are very right to be extremely cautious with this type of currency issuance. So if I think about what the world could move to, I think, having all that in mind, we could see now that there is a little bit of action on the technological side and some private actors pushing for issuance of new digital currency. We could see actually a competition among central banks to develop much more high-tech international payment and settlement system, especially cross-border, where it's missing. But there, I think what is really very different, and what would be very different compared to the past international monetary system that we have been describing, is that in such a world, data becomes really key. Okay, and all these lock-in effects that we have been discussing, linked purely to network externalities and complementary use in currencies, etc., well, it would be really different in the world where central banks issue currencies and they get all the data. And we could think that the lock-in effects in such a world, with complementarities between means of payment and credit, etc., that could play out very differently. And in such a world, if we think about the geopolitical implications, that could be really tricky, because you could see very much a game of some central banks or some countries wanting to increase their network of payments, where the lock-in effect would be even stronger than it currently is. So I think there are very profound geopolitical implications to such a technological change in the international monetary system, if it were to happen, but I think it's a clear possibility. So to conclude, I think, so I've done some non-speculative talk at the beginning, which is to describe the dollar hegemon, the international balance sheet of the US, the role of the US in the global financial cycles, what it means for macroprudential policy, etc. The new Triffin dilemma also, which is quite close to the old Triffin dilemma in some dimensions. But if the new Triffin dilemma is true, and there's a possible switch to a new international monetary system, then I think we can speculate, and there I'm not sure, I'm just giving you my speculation about what the new international monetary system could look like, but I think we could see indeed competition on cross-border payment technologies. That would be the most obvious step to take right now. And if this is the case, this would really change a lot of things for the functioning of the international monetary system. So let me stop here. Thank you.
Thanks very much, Elaine, for a lecture which I think is really a perfect Finch lecture. For a lecture where you've given us a wonderfully clear and comprehensive overview of a whole lot of research you've been doing on global financial cycles. We've got a little bit of time for questions, and Elaine's happy to answer some questions if anyone. Yep.
There are two possibilities regarding the usefulness of all this knowledge, research, and so on. One is that it is no use in predicting when the next low is going to be in global financial cycle, in which case we all wasted our time. The second possibility is that it enables you to better predict when the next low in global financial cycle is going to be. So my question is, when do you think it's going to be? Thank you.
So I strongly think that it's a misunderstanding of what economics is about, to think that economics is purely about predictions and forecasts. Okay? Most of the value added of economics, I think, is about understanding mechanisms and different forces shaping what the world looks like, but not about having a precise point estimate of various phenomena. So we can have point estimates of various phenomena. For example, I've given you some trends for the US dollar. Okay. However, if I don't have the exact point estimate about the US dollar, I won't consider that a failure of economics, nor of my research. Because evidently we are dealing with an extremely complex system, and we are trying to put structure to this world. So we cannot reduce that to doing forecast. So I would discount the premise of your question totally.
Professor Ray, you mentioned Lehman Brothers and the global financial crisis. Your view on regulators, are they following the curve or are they leading the curve? And also why?
So we have made quite a lot of progress since the great financial crisis. Fortunately, because as we have seen, there were lots of, I would say, missing elements in regulation and in supervision in the 2000s and in the lead up to the crisis. So we didn't see much in terms of the leveraging up of the financial system, and we grossly underestimated the amount of capital that banks needed. So we didn't pay much attention to the risk-taking behavior, the incentives that were given to employees, and all this. So we have, since Basel III has happened, which has corrected to some extent some of these flows. So we've seen a lot more capital buffers in the banking system, which is good. And we also see the development of these famous macroprudential policies that I discussed in my lecture. So I still think in that respect that we are learning a lot, because we are not used to use countercyclical buffers, for example, in macroprudential policy, or in some countries we are not used to use instruments to reduce lending in the housing market in boom times, such as debt-to-income ratios or stuff like that. In some countries, we don't have even the legal tools to do that. So this is a slow process, very slow, and there are lots of unknowns which are now, I guess, on the table, but are not, or we cannot really tackle in any deep ways. The fact that we have re-regulated to some extent the banking system also means that we have now development of non-bank actors, who are doing some credit creation or maybe are leveraging using some derivative instruments. So there are different types of interconnections which are developing between banks and non-banks actors. And on these type of issues and their implication for financial stability, we don't know that much. So I think this is a clear question mark for the near future, whether we can get a better handle of the interconnections between insurance companies, mutual funds, hedge funds, and banks, and whether we could, if we saw some danger developing, what kind of tools we could use to, macroprudential in particular, to intervene. I think we don't know enough. So I can clearly see some danger.
Thank you.
Good evening, Professor. Please allow me to use some time to structure my question. Recently, a hot topic is the US and Chinese trade war. I recall you mentioned a point that to resolve the external deficit, one measure is to expanding future net exports. That is the trade adjustment channel. I just wonder, would you be able to elaborate a little bit about the impact on the US-Chinese trade war, and also what is the relation with, the monetary policy and etc.?
So, as I mentioned, when a country has an external deficit, there are two ways that it can make up for this deficit, so respect its intertemporal budget constraint. One is the trade channel, which means net export growth, and the other one is the valuation channel. So in the case of the US, it's in a way the US is helped very much by the valuation channel because, as I mentioned, it earns 2% excess return on average on its external position. So that means that even if it doesn't run these future net exports, it already makes up for some of the deficit via this valuation effect. So that makes the position of the US in a way more sustainable. That's the soft budget constraint compared to other countries. So therefore, I wouldn't push any, quick, sharp adjustment of any kind. I think there's no need for that. And so I see the trade war as a little bit of an orthogonal question to that, which depends pretty much on some policy decisions, which I'm not sure are fully rational.
Thank you, Professor. Australia is an example of a country with a very large trade in a major trading partner is China, followed by the US and also Japan. What will lead Australia to, and other similar countries, to transact in the currency in which the trade is taking place rather than, as you suggested with the data, through the US dollar?
So again, the future of international monetary system has to be about speculation at this stage. So I'm willing to speculate a little bit, right? So indeed, it seems like in history, when a currency is more used in international trade or in international financial markets, so if we have more trade being invoiced in dollar in the past, this leads to more people wanting to use dollar assets, etc. And there's a kind of progression from a currency used in international transaction on the goods market side to being more important in the financial market side, provided that the financial system, is adequate. So the banking system is efficient, etc., etc. So one could see that. With the rise of China in international trade, if there are very efficient payment systems being developed in RMB and gradually taking over in the neighborhood, then there will start to be more network externalities in that type of transaction system, and that at some point could be attractive for other countries who are outside that system to join it, simply because if you have a lot of people coordinating on a certain currency and you trade a lot with them, that decreases your transaction cost, right? So that would be the kind of natural way these things have developed in the past. Now, looking forward, we may have different considerations because as I try to speculate at the end, the big difference with the kind of more digital payment system would be the data. And so how we are going to react to this new element, I'm not sure.